Understanding the intricacies of manufacturing profit can feel like navigating a labyrinth. You've got your products, your team, your machines, and, oh yes, your costs. And when it comes to costs, there are two major players, fixed costs and variable costs. If you're just starting out or even if you've been in the manufacturing game for a while, grasping these concepts is crucial to your success. So let's break it down together, shall we? First off, let's talk about fixed costs. Imagine you're running a bakery. You've got your rent, your insurance, your salaries, and all those lovely overhead expenses that you have to pay no matter how many cupcakes you bake. That's fixed costs for you, expenses that stay the same regardless of your output. Whether you whip up one cupcake or 100, those costs remain constant. It's like that annoying subscription service that keeps charging your credit card every month, even if you forget to use it. You can't escape it. Now, think about your rent. That's a classic fixed cost. You sign a lease for your bakery, and whether you're busy baking or just staring at the wall, that rent is due. Salaries, same deal. You have to pay your staff regardless of how many loaves of bread you sell. Insurance, yep, that too. These fixed costs can be a heavy burden, especially if your sales dip. They don't just vanish when business slows down. But here's the kicker, while fixed costs are tough to change without altering your business model, they're essential for planning. Knowing your fixed costs helps you predict expenses and assess profitability. It's like having a safety net. You know what you need to cover every month, and that gives you a clearer picture of your financial landscape. Now, let's switch gears and talk about variable costs. Picture this, every time you bake a batch of cookies, you need flour, sugar, eggs, and chocolate chips. The more cookies you make, the more ingredients you need. That's the essence of variable costs. They fluctuate based on your production levels. If you decide to bake 500 cookies instead of 100, your ingredient costs skyrocket. Variable costs can include everything from labor to raw materials to energy. If you're using more power to run your ovens, your energy bill will rise. If you hire extra help during the holiday rush, your labor costs will spike. Understanding these costs is vital for maintaining profitability, especially in a competitive market. Now, you might be wondering how fixed and variable costs interact when it comes to profitability. It's a delicate dance. Fixed costs are usually higher than variable costs, and they can have a more significant impact on your bottom line. If you have high fixed costs, you need to sell a lot of products just to break even. On the flip side, variable costs only affect your profitability when you're producing. If your sales are low, your variable costs drop too, but that doesn't help you cover those pesky fixed costs. So, how do you make sense of all this? Understanding your fixed and variable costs helps you assess your break-even point, the magical moment when your revenues equal your expenses. This is crucial for any business. You need to know how many cupcakes you need to sell to cover your costs, and start making a profit. Let's say your bakery has fixed costs of $10,000 a month, and you sell your cupcakes for $5 each. If your variable costs are $2 per cupcake, you can calculate your break-even point with a simple formula. Break-even point equals total fixed costs divided by the selling price minus variable costs. So, in this case, it would be $10,000 divided by, which equals about 3,334 cupcakes. You need to sell that many cupcakes just to cover your costs. But how do you shift from that break-even point to actual profitability? There are a few strategies you can employ. First, consider reducing your fixed costs. Can you negotiate a better lease? Cut back on non-essential expenses. Next, think about increasing your selling price. A little price hike can make a big difference in your bottom line. Just remember to communicate the value of your product to your customers. Another way to boost profitability is by decreasing your variable costs. Negotiate better deals with suppliers or find more cost-effective ingredients. You could even look into automating some of your processes to increase efficiency. And of course, increasing sales is always a surefire way to improve your profit margins. Market your products effectively, expand your customer base, and watch your sales soar. Now, let's talk about some practical tips to keep manufacturing costs low. First, embrace automation. It can improve efficiency and reduce the need for manual labor. Lean manufacturing techniques are also your friends. They help you eliminate waste and streamline your production processes. Outsourcing non-essential activities can also save you money. If marketing isn't your strong suit, consider hiring an expert to handle it. Reduce your inventory levels to cut down on storage costs, and use cost-effective materials without sacrificing quality. Remember, every little bit counts when it comes to your bottom line. Streamlining your production process can also help. Eliminate unnecessary steps and focus on efficiency. And let's not forget about reducing scrap and waste. Every ounce of material you save can go straight to your profits. Implementing just-in-time manufacturing can help you keep inventory low and reduce storage costs. Finally, consider partnering with other businesses. Sharing resources can lead to cost savings for everyone involved. Collaboration can be a powerful tool in the manufacturing world. Now, how do manufacturers actually calculate their profits? It's a straightforward process. First, they calculate their total revenue by multiplying the selling price of their goods by the number of units sold. Then, they subtract their total costs, both fixed and variable. The result is their profit. But don't forget to factor in taxes, which can vary depending on your location. Understanding fixed and variable costs can be challenging, though. One major hurdle is distinguishing between the two. Fixed costs remain constant, while variable costs change with production levels. Allocating fixed costs to specific products can also be tricky, as some costs, like marketing, don't easily break down by product line. Predicting variable costs can be another challenge, especially when raw material prices fluctuate. And managing fixed costs is crucial. You need to keep a close eye on those expenses to avoid overspending. Minimizing variable costs is equally important, whether through negotiating better prices or increasing production efficiency. In conclusion, understanding fixed and variable costs is vital for anyone in the manufacturing industry. It's about knowing where your money goes and making informed decisions that can lead to greater profitability. The challenges may seem daunting, but the benefits of mastering these concepts far outweigh the difficulties. So, how well do you understand your business's fixed and variable costs? Are there areas where you could improve? Take the time to analyze your costs, make adjustments, and watch your profits grow. After all, knowledge is power, and in the world of manufacturing, it's the key to success.